Are the banks we've trusted for years still a reliable place to stash our cash? Did you know that your local bank branch may be on the verge of extinction? That's right, the US banking sector is shrinking at an alarming rate, with major banks closing down branches and consolidating operations. But what does this mean for you, the consumer? And what's driving this trend? Join us as we uncover the surprising realities of the dwindling banking industry and how it could impact your financial future. In this video, we'll dive into the shocking truth about the state of banking in America and what it means for you. We'll explore the fascinating and sometimes surprising world of banking in the US and why it's undergoing such a dramatic transformation. Don't miss out on this eye-opening exploration that could change the way you think about your money forever. The banking industry has always been an integral part of our economy, providing financial services and credit to individuals and businesses alike. However, in recent years, the US banking sector has been undergoing a significant transformation, with many banks closing down their branches and consolidating their operations. This trend of shrinking banks has not gone unnoticed, with banks borrowing more from the Fed, and it has raised concern among consumers and policymakers alike. But what's driving this trend? One factor is the increasing competition from online banks and financial technology companies that offer innovative services such as mobile banking and peer-to-peer lending. These disruptors are changing the landscape of the financial industry, making traditional brick-and-mortar banks seem outdated and inefficient in comparison. Another factor is the cost of maintaining physical branches. With the rise of digital banking, many customers prefer to do their banking online, reducing the need for physical branches. Maintaining and staffing these branches can be costly, especially in areas with low foot traffic. So, what does this mean for consumers and businesses? On the one hand, the shrinking banking sector could lead to less competition, potentially resulting in higher fees and less access to credit. On the other hand, it could also lead to more innovation and better services as traditional banks adapt to the changing market. As the financial system in the United States undergoes upheaval, banks are seeking assistance from the Federal Reserve in the form of loans to help them weather the crisis. Amid the turbulence caused by the recent failures of prominent banks like Silicon Valley Bank and Signature Bank on March 10th and March 12th respectively, some financial institutions are struggling as customers withdraw their funds and stock prices fluctuate wildly. In light of this tumultuous environment, some banks are in need of immediate cash injections, whether to repay their clients or to ensure their financial stability during this difficult period. This is where the Federal Reserve steps in. The central bank was established in 1913 with the aim of providing a safety net for the banking system. It can lend money to financial institutions using their assets as collateral, providing them with quick access to cash that they might not have been able to generate by selling these securities on the open market. However, the Fed is now taking this one step further. On March 12th, central bankers launched a program that lends to banks using their financial assets as collateral, as though these securities still hold their original value. This move was made necessary because as the Fed raised interest rates to curb inflation over the past year, bonds and mortgage debts with lower interest rates became less valuable. The Federal Reserve can protect banks from selling securities at a significant loss by lending against their assets at the original price rather than their current market value. This approach could reassure depositors and prevent runs on banks. According to data released on Wednesday, two key programs lent a total of $163.9 billion this week, which is similar to the previous week's lending of $164.8 billion. This is significantly higher than the usual borrowing of less than $10 billion in the Fed's discount window program. The substantial lending highlights the persistent stress in the banking system, raising the question of whether the government's response, including the implementation of a new lending program by the central bank, will be sufficient to alleviate the situation. The discount window is the Federal Reserve's original tool for lending to banks against collateral and is known as DISCO in financial circles. Although it has been stigmatized in recent times, it is the more conventional of the two lending programs. In the past, There was a perception in the financial industry that borrowing from the discount window was an indication of distress. While the identities of borrowers are released, it is done so on a 2-year delay. Despite this, community banks tend to be the program's most frequent users, with larger regional lenders such as Bancorp accessing it during the initial stages of the pandemic in 2020. Fed officials have modified the program's terms over the years to make it more appealing during times of stress, but with varying degrees of success. The Federal Reserve's Bank Term Funding Program is a new lending facility that is similar to the discount window but more powerful. It utilizes the central bank's emergency lending powers, which date back to the Great Depression, and can be used during unusual and exigent circumstances with the Treasury Secretary's approval. The program allows the Fed to lend against treasuries and mortgage-backed securities at their original value for up to a year. Policymakers intend to use the program to alleviate the current issue of interest rate risk in the banking system, while also circumventing the stigma of borrowing from the discount window. In recent years, banks have been borrowing more from the Federal Reserve, the central bank of the United States. This trend has been especially evident since the COVID-19 pandemic began in early 2020, as banks have faced increased uncertainty and risk in their lending activities. Banks borrowing more than usual is a cause for concern, as it may indicate financial instability and an increased risk of default. Both the discount window and the Bank Term Funding Program appear to be effective in helping banks weather the recent financial turmoil. Discount window borrowing has increased significantly, rising from $4.6 billion to $110.2 billion in just a few weeks. Although borrowing fell slightly to $152.9 billion before rising again, the current levels are still notably higher than normal. The new program has also seen an uptick in borrowers, with borrowing levels increasing from $11.9 billion to $53.7 billion in the same time frame. The identities of the specific borrowers will remain unknown until 2025. Banks are the bedrock of the global financial system, and their stability is crucial to the functioning of the economy. Therefore, any significant changes in their borrowing patterns can raise red flags and send shockwaves through the financial world. Recently, there have been reports of banks borrowing more than usual, and this has left many wondering whether this is a sign of trouble. While there may be legitimate reasons for banks to borrow, the increasing trend of borrowing could be a warning sign of deeper underlying problems in the financial sector. One key issue that analysts are grappling with is whether the bank's increased reliance on these programs is a positive or negative development. While the backstops appear to be doing their job in providing liquidity to financial institutions, the fact that some banks are still tapping into them could be a cause for concern. There are signs that depositors are pulling their money from some banks and moving it to other investments or larger banks. Silicon Valley Bank's collapse exposed vulnerabilities in the banking system, prompting depositors to scrutinize similar institutions and withdraw their cash. PacWest Bancorp is among the banks that have been struggling and borrowing from the Fed's discount window program. The world of finance is a complex and ever-evolving system with many moving parts and interconnected players. This trend of increased borrowing could actually be a good sign, indicating that the economy is on the upswing and banks are expanding their lending activities to meet the growing demand for credit. The bank's comfort in using the Fed's tools could help soothe depositors and financial markets, preventing further problems. In contrast to past times, borrowing from the Fed does not carry the same stigma this time, as the securities held by the banks are not at risk of default, but rather are worth less in the bond market due to the quick rise in interest rates. Co-Chief Investment Officer at PGIM Fixed Income, Greg Peters, sees this as a unique situation, unlike anything he's seen before. It's clear that the shrinking banking sector in the US is a complex issue with far-reaching implications. From the availability of credit to the safety of our deposits, the impact of consolidation and downsizing is something we all need to consider. But what can we do to protect ourselves and our finances? It's important to stay informed, seek out the advice of experts, and remain vigilant in our financial decisions. We hope this video has shed some light on this important topic and sparked some thought-provoking conversations. As always, thank you for watching, and be sure to like and subscribe for more informative content.